This is Smart Investing with Mike Wren.
Attention, savage humans, especially the sexier of you, savage. Get ready to have your universe rock.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren.
The fact that the right way is also my way is a happy coincidence.
With Michael's producer, Chris Martin.
You're forcing me to do something I don't like to do. Tell the truth.
This show is live. And call-ins are welcome. Or you can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike Wren.
Well, good morning, everybody. How are you doing out there this fine morning? You have tuned into, for one reason or another, maybe on purpose or by accident, you've tuned into the show Smart Investing, where, I am Mike Wren, your host. Been on the air for what? We've been on the air a decade now. And this is the type... over. Yeah, probably. This is the show where we take the topic of investing. Number one, we make it easier to understand. Number two, we try to get you good, relevant information on each and every show. And thirdly, we try to be entertaining. And with the entertaining portion is my producer, very, very extraordinaire, Mr. Chris Martin, who's wearing a shirt that is a silkscreen shirt, but it's got a huge name tag silkscreen to the front of it where it's the whole chest portion that says, "Hello, my name is," and then there's a star, and then it's Star-Lord, like a 6-year-old wrote it. Star-Lord, yeah.
You know where that's from, though, right?
No.
Oh, from the new movie, Guardians of the Galaxy?
Yeah.
It only made like $112 billion this weekend.
That's
like
a lot.
The top movie right now.
That's a lot.
It was an awesome movie. Not quite as good as the Avengers, but I took the whole family and they all had a ball.
So would young kids like it as well as older kids?
Yeah, I mean, there's a couple of
cutoff?
like dirty words. I mean, not F words or anything, but
we're
but
okay
other than
there.
that, it's like Avengers. It's a comic book movie.
We're talking my kids.
Your kids probably they've probably heard them all, so it's not a big deal.
Yeah.
This is probably
they might have heard them all this morning.
just coming to work.
Just kidding.
Just pulling out of the driveway. Dad likes to empty out his vocabulary. This is probably like this generation Star Wars.
Is it with the animals and stuff in it?
It is, but you will love it.
Okay.
Bradley Cooper is one of the animals.
Okay.
Vin Diesel is another one.
Well, I tend to believe you on those things. I really do.
They all had a ball. And it's one of those movies that I love because you walk out happy. Like the credits roll and you're like, "Oh, that was fun." And then you leave. You didn't just watch Seven or something.
Well, it is supposed to be entertaining.
Yeah.
It is a movie.
It was really good.
Okay. So, I think...
And so that's in the movie he thinks in his head he's a big deal. Oh. And so when these guys capture him and he goes, "Maybe you know me by my name, Star-Lord." And the guy's like, "Who?" "The Star-Lord, man. Come on."
Your wardrobe is always timely.
I try to be fresh.
Always
with
timely.
my nerdisms.
So anyway, everybody, this is a show, believe it or not, about investing. And on today's show, we're going to continue to be different like we always are from the rest of the industry and from the rest of the financial press, the financial shows that are out there. Because if you step back and take a look at it, the financial shows, number one, they will talk about current events to be current. Okay, so they're going to talk about interest rates going up and down, interest rates being very, very low, what the Federal Reserve is doing. And since it's not news anymore, since it's editorialized, they will actually start giving you opinions on stuff. And for the most part, they're not qualified to give an opinion because they're journalists. They're not economists.
Well, and most of those shows also will go, Iraq is being attacked. So the market, blah, blah, blah.
Yeah, and they don't,
and there was a big dust spill in Australia and blah, blah, blah.
There's another good local show where the fellow, I believe, is qualified to talk about stuff, to talk about economics and all that. But the problem is that the reason that I don't do that, there isn't a problem with them doing that at all, of course. The reason that I don't is that I have typically found, at least in my practice or the way that my personality meshes with the world, there isn't any economic event that's going to make you, the listener/investor, do anything. The only thing that I have found that anybody ever does is that they will panic out at the height of the bad news of whatever's going on currently. And they will also figure out a way to find some money to buy at the absolute top of the hype of whatever's going on currently as well. That's the only time that I've ever seen listeners, investors, normal people on the street ever do anything with their money based on the news. It's at the height of fear and at the height of greed where it's going to go up for forever. Obviously, those two areas make up the smallest portion of any sort of newscast, or those make up the smallest portions of our lives. That's a problem, because since they're small portions of our lives, they don't come around too often. And since they don't come around too often, it's hard to learn from something that happens seldomly, and it's hard to recover from those bad decisions that you make seldomly. They're big deals, in other words. You panicking out at the bottom of a market and unwittingly maybe just being a bit too aggressive at the top of some sort of a frothy area, those things really come back to bite you, and you don't get another chance to make amends because they don't happen all that often. So what you probably realized if you're listening to this show, and you've listened probably for a while, I try to focus on where the rubber meets the road, where we can actually make some changes either to your behavior, and therefore that will make you perform better, make your investments perform better. And just like if we could probably do the same show, it would even be more boring if this show was. I don't
know if that's possible.
Yeah, just think if it was on weight loss. Okay, if I was doing a show on weight loss, it would always be about either diet or how many calories you're burning. It'd either be what you're putting in or what you're burning up.
Right. We could talk about different exercise bikes, but
yeah, we could talk about different ways to try to trick yourself into behaving better and losing more weight each and every day. That's essentially what I'm trying to do with the show, is ways to trick you to behave better when it comes to investing. That's really, really my goal, because the investor's behavior is the number one deviant that I see when people don't get the types of returns that they want. Number two, my industry, I don't know what they do anymore. My industry, let's take an example. It's a pretty sad state of affairs that I can tell you that if you work with Edward Jones, otherwise known as L. Ron Jones to this investor, if you work with Edward Jones, I can quote you chapter and verse. Number one, I know that you own a substantial amount of an investment called Capital World Growth and Income. Number two, I know that you own an investment called Growth Fund of America. Number three, I know that you own an investment called American Mutual Fund. Are they bad? No. Is it kind of strange that I know what you own just by who you work with? Yeah, it is kind of strange. Is it a bad thing? Let's just say it's not great, okay? And I would be able to tell you from my knowledge of my competitors that over the years, that's where the majority of your money at Edward Jones would have been accumulated, as well as into tax-free bonds. But now Edward Jones has gone down the path where instead of you owning a few good funds that all of the clients own, they've gone down this path about putting you into 12 and 14 different mutual funds. Why? Because I've seen it. It's facts. I can prove it with statements. Isn't it weird? I happen to know that if you work with a firm called UBS, that you're going to be lucky if you are charged 1.5% per year. It's probably higher than that. Are you going to own any individual companies? No. Are you going to own every sort of packaged product known to mankind? Yes. Are all of the big firms trying to get more relationships with you? Are they trying to get you to have a checking account? Are they trying to get you to have all of these links and become a huge part of your life? Yeah. Why is it that I know that? Okay? Yeah. I know that because I know what's going on out there, and it's just not a great thing. So when we come back from the break, we're going to be talking about some individual companies and how you might want to think about them. And I haven't really decided exactly what tact I'm going to take this show, but we'll figure it out as we go along.
This show doesn't believe in tact. So.
You're right. I'm Mike Wren. It's the show Smart Investing. You're listening live at 590 KQNT. Telephone number here to the studio is 509-241-5900. Thanks for listening. We'll be right back.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.
This is Smart Investing with Michael J. Wren.
He's awesome. You can't read his thoughts because he doesn't have any.
This is Smart Investing with Michael J. Wren.
Well, maybe now's not a good time to buy. You guys are young. You should be burning through your money like a coked-up rock star.
You should listen to him. He's a financial advisor.
Finally, somebody that has the same sort of care and feeding to the clients as me.
Don't call and bug me, and if you're young, you should be burning through your money.
Okay, yeah, let's start with that. Okay, right now we are... I'm able to find good deals with individual companies, but I'm not able to find as many easy, just no-brainer good deals as I was a year and a half to 2 years ago. Okay, what does that mean? It just means what it means. It means that all of the 50% off sales, not all of them, but most of them are gone. Okay, what that means, the corollary to that is that you will have probably seen your portfolios go up. Okay, that's good. That's good. You're not going to see your portfolio go up as much as this year as last year. And I'm telling you that when half the year is, more than half the year is over. But I'm sure that since you're listening to this show, you're reasonable, and you didn't think that after the S&P 500 was up I think it was up 30% or in the high 20s. It's not going to do that again. I mean, it could do it, but it's probably not going to do it again. It's not going to be that great, okay? So, that's normal. Did anything that I just say tell you that the market's up for a crash? No. Last week or the week before, the things are kind of running together because the week before last, I missed most of the week because of an extremely high fever with a virus. I don't know. I was just sick. So
you got that monkeypox thing going. I think.
Yeah, I kid about it, but maybe I did have bird flu or something. So anyway, I was sicker than a dog, and I happened to realize that things were going down, and it's no big deal. A few hundred points here and there is not a big deal when you've got a market when you're talking in thousands of points, okay? It just happens. It's noteworthy, but it's not newsworthy. It's like, oh yeah, okay, it went down today, no big deal. I mean, whatever. It does it on the other side too. So, what I would tell you is that things are more normalized now, and let's look through the windshield. Let's go over some fundamentals. Number one. Let's make sure that you as an investor, more than likely if you're an investor, you tend to be some of the older part of the population because you have accumulated assets over time and you have been frugal. Those are usually the only people that are investors. If you are in the point of your life where you want to start taking some level of income out of your investments, I'm of the opinion that you should have a year's worth of that income set aside ahead of time. Okay? That just means to do enough selling in your portfolio or capturing enough of the dividends to set them aside and say an earmark it for 2015 already. Okay? So that's the first fundamental issue right now is that your 2015 income, you should already either have that sold and in cash and earmarked for where it's going, or by the time January 1st rolls around, you should have it earmarked and take it out. Number 2, my advice to you would not be to take out 12 payments once per month for next year's income. Take it all out in January, put it in your bank. Okay? Why? Well, because there's no reason to leave that cash in your investment account. Number 2, if you know that you're going to spend it in 12 months, I don't see any reason to take any market risk with that money. What I mean is just the short-term volatility. Why take that extra volatility when you don't have to, when you know you're going to spend the money anyway? So segregate that. And I would do it in one chunk instead of having I try to make things as simple as possible. If you know you're going to spend the money, number 1, why have it invested? Get it out of the investments, get it into cash. Number 2, if you know you're going to spend it in a year's time, why torture yourself with 12 checks? Do 1 check. That way you don't have to look for 12 transactions throughout the whole year to make sure that they're correct. That way I don't have to do it. And it just simplifies your life. It makes your bank account ledger much, much smaller because you're taking away a transaction. I do that nowadays. I carry a lot of cash on me to do little transactions here and there because when I get my bank statement, I just don't want a lot of debit card purchases. You know what I mean?
Oh, okay, yeah.
Yeah, that drives me nuts. It's like,
and it's hard to make track and write them down and make sure.
Yeah, so I just take the cash out and say, I want my bank account, the statement that I get, I want it to be a few pages thinner. And it's worked.
And you can tell people with inexperience with that because when I was working at the store, you'd be like, $1 here, I'll put it on my card, and $1.50, and they come back, I just want to pop, just put it on that card, and just constant nickeling and diming.
Yeah. So anyway, I'm all for making things more simple. The other thing that does is that it gets, if you've already segregated your year's income to let's say to the edge of your game board, now you can just play the game. Now you can just be in the rest of the money that's in your investment account. Now you can worry about it a little bit less because the money that you have already set up for yourself to spend throughout the year, it's already in cash. So the market volatility that affects your investments, I would hope that it would be less emotional for you. Okay? Here's another thing too, is that now that we are off the bottoms, off the very, very lows of the market from 5 or 6 years ago with all the emotional things going on, we're more in a medium area, a middle area before we march on, as we march on to higher and higher highs. And there's going to be down days between now and whenever for the rest of your life. How should you think about that? My competitors, the whole realm of journalistic people that talk about the investment industry, they use the word risk. They use it too much. It's almost like a 13-year-old girl using the word love. It's probably overused, okay? They really don't know what the hell's going on. The real risk in almost any investment is that you're going to panic out of it and sell it at a bad time. Now, here's how you can equate that. If you are running that 7-Eleven store that I always bring up, or if you are running that Papa Murphy store, what if you were forced to sell it? What if something happened so bad that you had to sell that business within 2 or 3 weeks' time? Obviously, when you're forced to sell, that has a negative connotation right away. You're probably going to get less money than what you normally would, right?
Yeah.
Okay. That's what happens in mutual funds. Number 1 is that when all of the individual investors out there decide that they know something, and they all of a sudden decide that they're going to get, quote unquote, safer when the market's going down, they will put in an order through their 401k, through their investment person. They will go from having an actual invested mutual fund, ETF, whatever kind of package product, they'll move it into another choice that's completely safe. In other words, cash. What did they just do? They just forced that mutual fund manager to sell all of those businesses at that exact time right into the teeth of a negative market. That's how come I concentrate on the panicking portion of clients. If we think about risk in the real way that you should think about it, owning that 7-Eleven is no more risky than owning money in the bank. You own it, you're running the business, you know what's going on. Now, sure, if you're forced to sell that business, that's where real risk comes in. In other words, if you own shares of common stock, you own these businesses. Don't set yourself up for an event where you're forced to sell. Also, don't force yourself to sell because of fear. Just because the prices of these individual companies might be down a year, might be down on a day, might be down for a few weeks in a row, just because the prices that the quote-unquote market is willing to pay you for those businesses, just because they go down, that does not mean that you are selling less gasoline at your 7-Eleven. It doesn't mean that you're selling less beer and pop and cigarettes. It doesn't mean that you're selling less candy. All it means is that the pool of prospective buyers, for some reason, has a bad attitude, and they're only willing to pay a certain level. And you figure, I don't care. I'm not forced to sell anyway. Things will change as the days, weeks, months, years go by, and you would be correct. If I can get you to think about that while you own your individual companies, number one, like I said, putting your needed income away first to the side. I said a year. Maybe you want a year and a half. Maybe you want to be more aggressive and say, oh, just 9 months. And I would say, how about a year? Maybe you want 2 years of income in the cash. Yeah, you're going to lose the earning power of those 2 years worth of income, but what's nice is the rest that's left in your investments, you're truly going to leave it alone. That's powerful, powerful, powerful. So, remember, don't force yourself to sell your businesses. Don't put yourself in a position where you're forced to sell them. That right there will help your returns. I'm Mike Wren. It's the show Smart Investing. You're listening live at 590 KQNT. Telephone number here to the studio. If you want to chat for a bit about some company or some topic, the number is 509-241-5900, and we'll be right back.
This is Smart Investing with Michael J. Wren, with producer Chris.
Well, not to worry, because for most of you, this job could be done by a monkey with a bottle of Motrin.
This is Smart Investing with Michael J. Wren, with producer Chris.
So happy to see you finally came to your senses and gave us another shot.
Hello, everybody. You're back with Smart Investing. I'm Mike Wren, your host, spelled W-R-E-N. And you can find me, I think, fairly easy on the internet. You can find us on the internet, on the web at smartinvestingshow.com. When you go there, it will allow you to listen to old past shows. And also, if you would like to call me at my office and discuss anything, the telephone number at my office is 888-747-5181. Here's another way that I can try to help you not panic and not force yourself to sell good companies when you should just rather keep them. In other words, let's concentrate on what you own. I would rather you not own more than one mutual fund, maybe two. I would rather you not own any exchange-traded funds. The only way that I would allow you to own an exchange-traded fund is if you, as an investor, could quote back to me, chapter and verse, how it's put together. If you know how an ETF is put together, I would submit to you that you would not put your money into it. I'm not talking sales pitch. I'm talking who gathers the money, how they get it to a commercial bank, what the commercial bank does with the money, what they do when they convert it into saleable pieces of a trust, and then how they divvy it back up and give it back to the broker-dealer for sale. I'm talking when you know the nuts and bolts of how an ETF is put together. I doubt very highly that you would invest in it. Just remember, the people moving all that money around, they work on Wall Street.
Is this one of those ignorance is bliss?
Yes. Okay. I'm here to tell you, they're not the Wolf of Wall Street people, but they could be. One of them is going to be for sure. I'm just telling you that that's where the next shoe will drop, is in the ETF industry. And so if you do your homework, Wikipedia it, do whatever you want, and figure out exactly how an ETF is put together, if you understand it, you won't like it. Okay? That should be enough said. So, what would make it easier on you, the investor, to be able to hold your investments through a down market, through a time where prices are falling? Well, I would submit to you that if you really liked what you own and had a great affinity for it, then that is the first step that would make it easier for you to hold those businesses through a bad climate on Wall Street. Okay? Well, if you have ETFs, I would submit to you, you have no idea what you own. If you have mutual funds, you have huge diversification, hundreds and hundreds of companies that you own. How in the hell can you be comfortable with hundreds and hundreds of companies when the prices are falling? You're not. I know, because everybody panics out of them. So I've answered my own question. I've answered the question for you, but that's what happens, is when you own packaged products, you get rid of them because you have no affinity for them. You don't know them. All you know is that when you get your statement, it shows less and less money on the statement. And all of a sudden you decide, I want to stop the pain. You panic out, which makes it even worse. So how can we stop that? Excuse me, still getting over that weird bird flu.
I have a cough button. Why would that button make you cough?
So, did I lose where I was talking? No. I still remember. So, when you're talking individual companies, remember back to 2007 or 2008. What were you doing with your life other than panicking about your investments? Did you talk on your cell phone? Yes. Did you drive your car? Yes. Did you eat? Yes. Did you drink water? I would imagine. Did you travel? Yes. Maybe by car, maybe by air. Did you stay in any sort of a hotel? Yes. Did you go out to eat dinner instead of just eat at home? I don't know. Tell me.
Now, is that a restaurant or fast food?
I don't care.
Oh, okay.
They're the same thing, aren't they? Fast food is the drive-through window. It's an actual restaurant when you go in.
Rarely do you go to Red Lobster and you just give it to me out the window.
Red Slobber. Okay. What I just told you is you were participating in the economy during the last meltdown that everybody was freaking out about. You were talking on your cell phone. Have you ever heard of cell phone companies? You were driving your car. Have you ever heard of oil companies or people that make tires, people that make stuff for your car, people that make cars? You ate. Where did you buy your food at? Okay? Did you go to Walmart? Did you go to Safeway? Did you go to Albertsons? What did you do? Did you go to Costco? Tell me. You were drinking water. Did you drink water out of your tap? Did you buy it bottled? Travel. Did you travel by car? Did you travel by air? Did you travel by hotel? Do you see what I'm doing right here? Even when everybody says, oh, the world is ending, au contraire. The world is not ending when you're having a pity party and you pull into Costco and the parking lot is full. If you happen to pull into Costco and the parking lot is completely empty and they're open, then you should worry. Okay? That means people are dying from the flu. That's the only thing that I could think of that would keep people away from Costco. How about you? What else? What's going to keep somebody away from Costco?
In mass droves?
Yeah.
It would have to be some kind of weird zombie flu.
There you go. If that isn't
and even then, there's businesses that need all their food and everything for their employees and stuff. So even then, you're still going to get a couple cars in there.
So these are not solicitations to buy or sell, but let's talk Verizon. Let's talk Vodafone. Let's talk AT&T. Let's talk, Costco. Let's talk Coke and Pepsi. Did you wash your clothes? Yeah, I think so. Let's talk Procter & Gamble. Hopefully you don't smoke, but if you smoke or if you don't mind profiting off the Asian people that do smoke in the Southern Hemisphere, just, kidding. I have to throw in one of those jabs,
You don't have to. You just
If you've ever been to Malaysia, have you ever seen anybody smoking? I think you have. So if you want to profit from that, I have a deal for you. Or if you see somebody chewing tobacco, okay? You can profit from that. Those are good businesses. Okay, to repeat myself, the Cokes and the Pepsis and blah, 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 and the Procter & Gambles. What's wrong with owning those businesses while everybody is, quote unquote, worried about the world ending? There isn't a darn thing wrong with that. Here's something else. What's wrong with owning a good personal computer company? I don't know. Beats the hell out of owning a company that makes tablets. What's the one electronic device where the sales are literally falling off a cliff? Tablets. Why? Because you can't do anything with them. You can watch videos, you can search the web. Have you ever tried to do anything on the keyboard, like even buy something? Unless you've got that one-click Amazon buy thing, where you can program it to...
That no one should really have.
Exactly. I get that. Unless you've got that, your tablet, I think, it's cute, but it's a waste. So do you see, you're still working on a computer and there's still a keyboard. My opinion is if there's no keyboard, there's no work being done. If you're going to do work, there needs to be a bona fide keyboard. And if you are younger than me and you think that the keyboard on your laptop is awesome, that just proves you're younger than me. Type all you want, okay? For me, that keyboard on a laptop isn't a real keyboard. It's just put there just to look kind of cool. So
now, what if it's like one of those laser keyboards that comes out?
I don't even know what that is, man. Just shut up.
just trying to help you not be technically Amish.
I'm not quite there.
Okay.
So what's wrong with owning those types of companies? I have a feeling that those types of companies, you're going to realize they're not going to go fall off a cliff somewhere just because some news anchor is telling you that the zombie apocalypse is upon us. Zombies probably still drink Coca-Cola for all I know. So there might be a great affinity to own those sorts of companies. Number one, you're actually going to know who they are. Number two, if you're working with a professional like me, I can explain to you, let's say, the difference between Unilever and Procter & Gamble. They're very, very comparable companies. When I can find one that's cheaper than another one, either based on its earnings or based on its book value, when you're dealing with a professional like me, I might be able to tell you, listen, Procter & Gamble, you're going to know it by Tide soap and this and that and on and on and on, and Crest and Gillette razor blades. Have you ever heard of Unilever? Oh, I don't know, maybe. Have you ever heard of Dove soap? Oh, yeah, well, that's Unilever. And a whole bunch of other brands that go along with that. Johnson & Johnson, it's not just a drug company. Have you seen those new lotions that have just exploded that have the brand name Aveeno to them, that they're supposedly natural and things like that? That's Johnson & Johnson. So when you're working with an investing professional like myself, and there's very few of us because most of them want to sell you some packaged product, when I'm actually trying to work with you and find good investments, when we're working together and we're having discussions about this company and that company, you're going to have a greater affinity for what you're invested in from day one. Here's something else. While you own companies, you're going to get some money in your pocket that the vast majority of the people in my industry have forgot about. When we come back from the break, I'll tell you what that is. I'm Mike Wren. It's the show Smart Investing. You're listening live at 590 KQNT. Telephone number here, 509-241-5900. Don't forget, you can find us on the web at smartinvestingshow.com, and we'll be back.
This is Smart Investing with Michael J. Wren.
Well, why do I rely on positive eBay feedback to boost my self-image?
This is Smart Investing with Michael J. Wren.
I've realized that I kind of skate by on my looks, so I've decided to let my personality emerge.
You really think that's wise?
I'm Mike Wren. It's the show Smart Investing. You're listening live here at 590 KQNT. Okay, so back talking about owning companies that you might have a great affinity for. That's going to help out in a multitude of areas, okay? Because I would submit to you that a company that sells soft drinks or cigarettes, it's going to, number one, initially be simple to you. And then after you do some homework on it, you're going to think, wow, not only do they do soft drinks, they do bottled water, they do these sports drinks, they actually own a little bit of food. There's just wonderful good news when you're talking about individual companies. Here's the kicker, is that when you find these companies that you think, yeah, working with a professional, making sure that we're paying a fair amount for companies, maybe a little bit less than a fair amount because we're finding a deal for one reason or another, yeah, I would be more comfortable with that. Okay, great. I'm going to make you more comfortable. So now that you've figured out that, yeah, I would rather own these companies that come hell or high water, they're going to be doing business. I can satisfy myself that they're going to be in business. So that's going to help me. Number two, working with, Mike Wren, working with him, he's going to make sure that I'm paying a fair value for the company. Sometimes we're going to get a deal. Sometimes we're not going to get a deal, but we just don't want to pay too much. We don't want to make the big mistake by paying a huge amount for a company. Well, that sounds pretty good right there, but I can make it even better. These companies that you have a high affinity for, guess what? They pay dividends. The dividend rate for most of the companies that I just mentioned, just offhand, is 3% or more. That 3% exceeds what you're going to get at the bank. Number two, that 3% exceeds the 30-year Treasury bond. Number three, that 3% exceeds the 10-year Treasury bond. So just the dividends, which is the cash flow that the business shares with its shareholders. It's a portion of the profits that they don't plow back into the business. It's a portion that you live off of, or you buy more shares with it, one way or the other. You're getting it. Guess what? That's pretty cool. So you're getting some cash flow. Now you're thinking about a down market where prices are lower, and you're thinking, okay, I don't own these packaged products anymore. I own these wonderful companies that I have a great affinity for, that I was helped by a professional not to pay too much for. And you're telling me I get a dividend, and that dividend rate right now is equal to or exceeds the 30-year Treasury bond? Well, that's pretty darn skippy good. I'm happy with that. I can make it even better. Those companies that I mentioned to you raise their dividends typically on a yearly basis. So that means at their fiscal year, every 12 months, more than likely, you're going to get a bump up in income. It's going to be a pretty severe bump some years. Some years it's going to be a mellow one.
When it's mellow, I should be worried, right?
No. So anyway, like Johnson & Johnson, go back 25 years, look at their dividend, and then look at their dividend today. What will be the difference? Somewhere around 2,300% increase. I would say that that's pretty significant. I would say that there isn't anybody that's ever talked to you about a packaged product that knows that fact. They're too interested in telling you that they've done tons of research, that they work for a great firm, that they are allocating your assets to try to help you avoid a down market, that they provide great service, they have worldwide research, that they are going to make sure that you see them 4 times a year, that they will send you birthday cards, that they will send you anniversary cards, that you should open a checking account. They're going to tell you all of this crap instead of saying, and by the way, you get a dividend from day one and it's going to go up from there. That's one thing they never tell you. Why? Because they're too busy selling you crap instead of being investors. That's who I'm competing against. Right now in my life, there is no competition from my competitors. There's only people that drink their Kool-Aid and just blindly follow them down the path of mediocrity. And then there's people that get, well, yeah, I'd like to own some individual companies as well. You're off to the races. It's a wonderful time to own some of these wonderful worldwide companies that, guess what, are based here in the United States. If you want exposure to Africa, guess what? Coca-Cola sells Coke in Africa. If you want exposure to anywhere else in the world, you can get it with a domestic company. We don't have to go to the geographic area of Malaysia to invest. In fact, I would advise against it. Why? Because they lie. The rest of the world lies. They don't have general accepted accounting procedures. It's called GAAP. You can't trust what they write down on their paper. Why would you want to invest in Chang's Chicken Farm based in the Guangdong province of China when you can just buy McDonald's and have them open some new stores in that area and make money hand over fist?
Because it doesn't sound exotic and it doesn't do anything for my friends when I brag about it.
You're right. And by the way, McDonald's is not a solicitation to buy or sell either. So, yeah. Number one, I repeat, if you're going to spend some money over the next 12 months, get it into cash right now. Maybe you want 18 months worth of cash. Perfect. That cash, when you're going to spend it in 12 months, why don't you just take it in a lump sum? That way it's already in your bank. You're a big person. You're a grown-up. You can budget it, okay? That means that you don't have to take 12 transactions to do it. After you do that, figure out what types of things that you do even when everybody else says the world's ending. Those types of things might be a path to really good businesses. You're giving your money to somebody even during market declines. Who are those people? What are their names? Find them out. I can help you. Don't pay too much for those companies. Guess what? Those companies, they pay dividends. That's more than your packaged products do. Your packaged products will pay certain types of dividends. Most of them will be lower than the dividends from these companies. And here is the final kicker. These individual companies raise their dividends. They raise them yearly, typically. Not every year. A lot of them, if they have a down year, maybe 8 out of 10 years you'll get increases. That's a heck of a lot better than 0 increases, isn't it? A la the packaged product arena. So there you go. You can get an income stream. You can get a rising income stream. It can be from a business that you are familiar with. It can be a business that a professional like me helps you not pay too much for. Like Starbucks. Starbucks trades at a higher price than a lot of other companies. I like Starbucks. Am I willing to buy it at the same level than I am as some of these other companies that trade more cheaply? No. But can we still buy a little bit of it and accumulate it over time? Yeah. Does Starbucks pay as much of a dividend as some of the companies I mentioned? No. Is it a solicitation to buy or sell? No. Just an example. But do you see what I mean? Those are the types of things that we want to concentrate on to get you to a point to where you're getting a rising income stream. You're making sure that your income that you want to spend, if you are in a place in life that you're going to spend it, we want to get that set aside ahead of time. And we want to get you to a place emotionally with these investments where you don't feel forced to sell them. When you are forced to sell a business, that's when you're going to lose money. I'm Mike Wren. It's the show Smart Investing. Thanks for listening today. We'll be back again next week, same place, same time. Again, the number to my office, 888-747-5181. Thanks for listening.
I said it before and I'll say it again. Life moves pretty fast. You don't stop and look around once in a while, you could miss it.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.
If you are a Washington